In this video, I'll explain what retained earnings are, show you how to calculate a business's retained earnings, and show you how to interpret your findings. If you're starting a business or just want some knowledge surrounding retained earnings for an investment you're looking into, I've got you covered. Retained earnings are a vital part of any business. Without them, many companies would have to borrow extensively from banks or flounder in the market. At the end of an accounting period, whatever's left over of the net income of a business after dividends are distributed to the owners, sole trader or partnership, or shareholders in a corporation, that's referred to as retained earnings. As the name suggests, it's the earnings retained by the company once all other profits have been distributed where they need to go. Retained earnings are one element of the owner's equity or shareholder's equity, and are classified as such when you go looking for it. The purpose of these earnings is to reinvest the money to pay for further assets for the company, which continues its operation and growth. Therefore, companies do spend their retained earnings, but on assets and operations that further the running of the business. By definition, retained earnings are the cumulative net earnings or profits of a company after accounting for dividend payments. It's also called earnings surplus and represents the reserve money, which is available to a company's management for reinvesting back into the business. When expressed as a percentage of total earnings, it's also called the retention ratio and is equal to 1 minus the dividend payout ratio. That means that net income and retained earnings are not the same things. However, net income along with net losses and dividends directly affects retained earnings. Net income is the total amount a company makes after taxes and expenses. A company is taxed on its net income. Retained earnings are the amount a company gains after the taxation of its net income. Therefore, retained earnings are not taxed, as the amount has already been taxed in income. Dividends refer to the distribution of money from the company to its shareholders. Many corporations keep their dividend policy public so that interested investors can understand how the shareholders get paid. Dividends are typically paid in cash to shareholders. To do this successfully, the company first needs enough cash, as well as high enough retained earnings. Other times, corporations may decide to distribute additional shares of their company's stock as dividends. This is known as stock dividends, and they issue common shares to existing common shareholders. Dividends can be paid out in the form of cash or stock. Whichever payment method the company may decide to use, it reduces RE in some way. For example, cash payments causes cash outflow and is recorded as net reduction in the accounting books. Cash dividend caused the company to lose liquid asset ownership. Therefore, in this process, the company's assets value in the balance sheet reduces. For stock payment, a section of the accumulated earnings is transferred to common stock. This reduces the per share evaluation, which is usually reflected in the capital accounting, meaning it does have an impact on the RE as well. A company that's focused on its expansion would rather not pay dividends, but instead retain the earnings for use on company activities. The cash can be used for researching, purchasing company assets, marketing, capital expenditure, among other activities that can support the company's further growth. On the other hand, a company which is still growing and has a low RE may not have many choices in most cases. It prefers distributing the dividends to respective shareholders. Businesses calculate their retained earnings at the end of every accounting period, typically monthly, quarterly, and yearly basis. The formula is retained earnings or RE equals the beginning RE plus net income and minus dividends. This accounting formula takes the retained earnings from the previous period plus the company's net income minus all dividends paid out to the shareholders to calculate the period's earnings. Let's look at an example. A company may begin an accounting period with $7,000 of retained earnings. These are the retained earnings that have carried over from the previous accounting period. The company then brings in $5,000 in net income and makes a total payment of $2,000 in dividends. The calculation for this would be $7,000 plus $5,000 minus $2,000, and that's going to equal $10,000. This means that the company has retained earnings of $10,000 for this accounting period. The retained earnings of a company accumulate over its lifetime and roll over into each new accounting period or year. If a company is profitable, it will likely have retained earnings that increase each accounting period depending on how the company chooses to use its retained earnings. So we've covered that the company's retained earnings depict its profit once all dividends and other obligations have been met. If the retained earnings of a company are positive, this means that the company is profitable. If the business has negative retained earnings, This means that it has accumulated more debt than what is made in earnings. When interpreting retained earnings, it's important to view the result from the company's overall situation in mind. For example, if a company is in its first year of business, having negative retained earnings is probably expected. This is especially true if the company took out loans or has relied heavily on investors to get started. However, if a company has been in business for several years, negative retained earnings may be an indicator that the company is not sufficiently profitable and requires financial assistance. When interpreting the retained earnings of a company, consider these factors: the age of the company. More senior companies will have had more time to amass retained earnings and therefore should typically have a higher retained earning amount. A company's dividend policy. If a business has committed to regularly giving out dividends, it may have lower retained earnings. Many publicly held companies make more dividend payments than privately held companies. The company's profitability. The more profitable a company is, the higher its retained earnings will probably be. And finally, the seasonality of a company. In industries where the business is highly seasonal, such as retail industry, companies may need to reserve earnings during the profitable periods. This means that a company may have accounting periods with high retained earnings as well as accounting periods with lower or negative retained earnings. Generally, investors don't have business interest in a lot of ventures and all they care about is high returns for their investment. If retained earnings are properly utilized, it can generate more income, which is a good thing for investors. On the other hand, a company's management has practical knowledge about the market trends and expectations in terms of future opportunity in which they can utilize the surplus earnings. Therefore, their decision to retain the earnings and reinvest or make dividend payouts always relies on their projection about future opportunities. However, to be able to make a decision in which both the investor and the company are guaranteed a win, the retained earnings past performance will be used to assess the trend. Therefore, they can decide whether to go for the dividend payout or opt for reinvesting for long term value.